Hey, I'm JT, Head of Marketing at Coinflow, and this is Stablecoins 201. So this is where stablecoins stop being theoretical and start solving a real problem. A traditional cross-border payment goes through a chain of correspondent banks, and each hop adds time, fees, and foreign exchange markup. A stablecoin skips that chain entirely. You're sending value directly to a wallet, and it settles in minutes instead of days, any day of the week. 365, 24 hours a day. So it can hold them, yes. But whether they count that as a cash equivalent on the balance sheet is a different question. And honestly, that part's kind of still being worked out through regulation, legislation, and best accounting practices. There's no single settled accounting standard for this yet. Some companies already treat certain stablecoins like cash equivalents, but only when the redemption rates are airtight and enforceable. So this is the distinction that trips people up a lot. A tokenized deposit is still a bank deposit. It's just represented as a token instead of a line in the ledger. The money never leaves the bank's balance sheet, and it's insured the same way a normal deposit is. A stablecoin is a completely different instrument, right? It's infrastructure, it's an asset. The issuers hold reserves separately off any single bank's balance sheet, and the token itself is a claim on that issuer, not a deposit at a bank. So the same convenience on the surface, very different legal and financial structure underneath, which is why you can see the importance of having everything buttoned up if you are gonna build a stablecoin program. So not from the issuer directly. The Genius Act specifically prohibits stablecoin issuers from paying interest or yield to holders. Where it gets a little murkier is third parties. So some holders earn rewards by lending stablecoins into DeFi platforms or maybe through an exchange program, but I'd be careful calling that settled ground. Regulators are actively pushing to close that gap too. So what's technically possible today may not be possible tomorrow. The stablecoin itself doesn't move. It's still worth $1 because it's backed one-to-one by dollars and short-term treasuries, regardless of what interest rates do. What changes is the yield that the issuer earns on those reserves. So if rates fall, that reserve income shrinks, and anywhere the income was being passed through as a reward or a yield program, that's gonna shrink alongside it. So the peg is stable, the economies behind it aren't immune to the rates, if that makes sense. No, and this is worth being pretty precise about. Regulators have proposed that even the bank deposits backing a stablecoin's reserves are only insured as the issuer's corporate deposit, not passed through to the individual stablecoin holders the way that your personal bank deposits would be. So if you're holding a stablecoin, you're not carrying FDIC protection the way that you would with money sitting in a bank account, right? If you have USD in a bank account, it's FDIC protected up to a certain level. That protection that you get comes from the one-to-one reserve requirement and mandatory public disclosure, not deposit insurance. So we covered in depth the Genius Act in our Stablecoin 101 video. I would definitely encourage you to check that out. But it's the first time stablecoins have actually had an actual framework instead of patchwork, right? So it requires full dollar-for-dollar reserves, monthly public disclosure, and real-time audits. Final rules under the Act are still being worked out and are due by the end of this year. Once that lands, you're gonna see a lot more businesses comfortable using stablecoins, specifically because there's now a clear regulated way to do it. That opens up innovation, and that's the whole point of the Act. Not to slow this whole process down, but to make it something that a serious business can actually build on. Honestly, that's the whole reason Coinflow exists. A merchant shouldn't have to track Genius Act rulemaking or figure out reserve accounting to accept a payment. We sit in the middle, we're a teammate of yours, we are the bridge, and we handle that compliance, the banking relationships, and the settlement mechanics in the background. The business just sees a payment that settles instantly, you get your money in seconds, we carry the regulatory complexity so you don't have to.